Chapter 13, Liquidity Ratios. In this chapter, we will be examining the liquidity ratios for the ABC company. Liquidity ratios help us determine the company's ability to meet its short-term debt obligations. Our first category of ratios, liquidity ratios. They tell us what our ability is to meet short-term debt obligations. The first is the cash ratio. The second is what we call the quick ratio or acid test ratio. And the third, the current ratio. Let us take them one at a time. The cash ratio is cash and equivalents divided by current liabilities. Cash and equivalents, $45,000, divided by current liabilities, $150,000. The ratio is 0.3 to 1. The standard is also 0.3 to 1. The company's cash position is adequate. Here we see cash and marketable securities. Cash, $35,000, plus marketable securities, $10,000. Total, $45,000 in cash and equivalents. Here we have total current liabilities of $150,000. Now we move on to the quick ratio. It is calculated as cash and equivalents plus accounts receivable minus allowance for doubtful accounts divided by current liabilities. The thinking here, accounts receivable are nearer to cash than any other current asset. Hopefully, most of it gets collected in 30 days or a little more. Here we have $182,000 in quick assets. Current liabilities, still $150,000. The result, 1.12 1 to 1. The standard is 1 to 1. That means our quick ratio is above standard. The company's liquidity so far is good. Here are the items that make up the quick ratio. Cash, $45,000. Marketable securities, $10,000. Accounts receivable, $130,000, less. Allowance for doubtful accounts, $7,000. The total, quick assets of $182,000. Now let's look at the current ratio. It's calculated as current assets divided by current liabilities. $350,000 divided by $150,000. Current assets, $350,000. Current liabilities, $150,000. That gives us a current ratio of 2.33 to 1. The standard, $2 of current assets counted for every $1 of current liabilities. Overall, liquidity is good. Now, let's move off the ABC company's records and consider this. We have worked with companies that had a current ratio of 0.7 to 1. Think how simple but powerful this analysis is. Just by calculating the current ratio, we can tell that the company is confronting a liquidity crisis. It has more current liabilities than current assets. It would need a capital infusion, either from stockholders or through a long-term loan. All that from one calculation, the current ratio.